Good afternoon, and thank you for joining us today. My name is Paul McQueen, and I proudly serve our Libra owners as the VP for Wealth and have the pleasure to work every day with our dedicated wealth coaches and financial planners. We're delighted to host our third in a series of 3 webinars featuring Doug Carroll, Aviso Wealth's tax and estate specialist. Doug's 2 previous webinars, from estate planning to estate doing, and the individual pension plan for business owners, plus other recent webinars such as our 2020 responsible investing webinar and our first time homebuyers webinar, are always available on the events page at libro.ca. 2020 will certainly be a strange year for many Canadians. Many Canadians receiving the Canada Emergency Response Benefit, or CERB or CERB payments. There are potential first-time do-it-yourself investors, and many of us have questions about expenses related to working remotely from home. In today's informative podcast-style session, Doug will share tips and reminders for this year's tax filing deadline. Doug is a tax and estate specialist with Aviso Wealth, a national integrated financial services company serving the wealth management needs of virtually all of Canada's credit unions, as well as a range of independent financial organizations. Doug has held roles in the life insurance and investment industry and combines that with hands-on experience running an estate planning law practice. So he's certainly able to offer practical insights into many personal wealth matters. Doug contributes to and has been quoted in financial industry media, including the Globe and Mail, National Post, Toronto Sun, BNN, CTV, Global TV, and I shorten the list down because there's many, many others. Doug holds a bachelor's degree in business administration and a master's of law, which is a really cool degree, by the way, master's of law, with a specialization in taxation. He's a trust and estate practitioner and a certified financial planner, and previously sat on the board of directors of the Financial Planning Standard Council, now FP Canada, the overseeing body for certified financial planning professionals in Canada. Professional qualifications aside, Doug gets the greatest satisfaction when people say he speaks in a language they can actually understand. We're about ready to get going on our 2020 year-end tax tips. We certainly do want your participation today. If you have questions, please feel free to use the chat feature available on the website, on the app, on the screen in front of you. Given the nature of today's conversation, we will probably be giving preference to questions of a broader, more general nature. If you have very specific questions, we may have to refer those to your local coach for follow-up, but we will follow up on those questions you may have. And don't worry if you're busy scribbling down notes and you miss a comment or two that Doug might have, there will be a follow-up companion piece coming sometime in the next few days. Other than that, I'm delighted to turn it over to Doug Carroll. Doug, take it away.
Okay, Paul, you give me such an intro. I was like, I want to hear what I have to say now. Appreciate that, and appreciate the opportunity again to join with Libro and have this webcast topic. So I have a friend, a colleague, who's going to move the slides ahead so I can be hands-free here on the next here, which gives you a rundown on the different categories of topics that we're going to get into. And as Paul mentioned, there is a written piece, and the written piece is a bulletin length. It's 10 pages long, going into much greater detail on these things than I'm going to get into here. And it tracks exactly along the same points that we have right here. So again, you don't have to scribble things down extremely quickly. There'll be that written piece will follow up, and you can obviously make notes of those things that you do want to look into a little bit deeper. So let's start then. We'll talk about first the COVID-19 situation that we're in right now. We're unfortunately having this unusual year, and if we can advance to the next slide. I've got a rundown here of the types of supports that have been made available. The public supports have been made available. These are the federal government supports that we have. The early ones, all the way up into the present, and the different characterization of them, whether they are non-taxable, the ones that went to families who are getting the Canada Child Benefit, the one-time payment to seniors, which was either $300 or $500 if somebody had old age security or old age security and guaranteed income supplement. And then for persons with disabilities, there was a $600 amount for those people who were qualified for that. So those items, the Canada Child Benefit was a $300 payment. All of those non-taxable, so they don't have to be reported. The other two, though, the early programs, the CRB, the CERB as we came to know it, as well as the student benefit, and then the later programs which are in place right now, I'm not going to list them all off here. All of those items are taxable. The thing to remember about these, though, is in the early stage, those first couple of programs, those were paid without any withholding tax associated with them. So whatever you might have received from that, and with the CERB, it was as much as $14,000. It then is added to other income that you have in the year. And so you're going to have a tax to be paid on that. And it's important then, one, to know or understand that that's going to happen, and two, to set aside money for the purpose so you're not scrambling come the new year. Even with the later programs that are in place right now, the withholding tax is only 10%, and that's likely going to be less than your actual tax liability unless you have almost no other income from other places. But in all likelihood, it will be more than that. So just make sure that you have totaled up how much you received and get a sense of how much tax will be due on that based on the total income for the year, and then determine how it is you're going to set aside the money to pay that. All right, so let's move off of that. Then we'll go on and talk about spouses and families. And in fact, it's even broader than this for the points that I have here. It is taxpayers generally, as well as their spouses and their families. So on the first item with tax refunds, we all like to get a tax refund. It's always nice to get a tax refund at the time that you get it. But the reality of it is that if you got a refund, the likely reason why you got that is because the withholding tax from you on your paycheck as an employee, usually, the withholding tax was higher than what your actual tax liability will be when we come around the point where you're filing your tax return come the new year. And so if you don't want that to happen, because basically what you've done is you've given an interest-free loan to the government over the course of the year that you're getting back when you file your taxes. If you would prefer to have that money available to you during the year, then you can file a form with your employer called a T1213, which reduces how much the employer will withhold from you based on certain things that it is not aware of, like Rrsp contributions you might be making directly, personally, not through your employment. So if you want to do that, then you can reduce the withholding and have that money available to you. Other people are quite content to get the refund at the end of the year. The second item here is about spousal RSPs. When you have earned income, you get RSP room. It's 18% of your previous year's earned income. You can either put that into your own RSP, or you can put it into a spouse's RSP. When you put it into a spouse's RSP, presumably you're the higher income person and your spouse is going to draw that off at a later point in time in retirement at an expected lower tax bracket rate. But sometimes what people will do is they'll use this in more of a strategic way, perhaps closing in.
Doug, it's Paul.
Looks to withdraw those funds even without getting right into retirement. But there's a limit to that. If the spouse on the plan withdraws those funds within 3 years of the year of deposit, then withdrawal will get contributor. And the way that the three, yes, Paul, yeah.
Doug, sorry, we are
breaking up.
Yeah, your audio is breaking up quite a bit. Would it be possible to try the phone number that we discussed previously?
Yeah, I'll switch over to the phone here. Just hang on a second.
Apologies for that, everybody. Just a slight audio glitch. Doug does have a backup phone number that he's going to join us on shortly. We're running the video content ourselves, so apologize for the momentary delay.
Okay, Paul, can you hear me there?
Yeah, the audio does sounds much better, Doug. Thank you.
Okay. I've muted my computer speakers. Are you hearing me now?
I'm hearing you clearly, and there's no echo.
Okay, so let me pick it up there, talking about the spousal RSPs. So the tax refunds, you can use a T1213 to reduce source deductions so that you use your money during the year. You don't have a tax refund, you have the use of that fund. With the spousal RSPs, if you want to be strategic about it and draw money out, again, RSPs are for retirement, but if you understand how the rules work, then you can make a contribution to the spousal RSP. And if you do that during this year, so in 2020, then the receiving spouse, the annuitant, can take the money out in 2023 and it'll be taxed to that person, not back to the contributor. If you wait until the beginning of the year, the usual first 60 days, the physical contribution happens in 2021, even though it reduces this year's taxes, which will mean that you'll have to wait an extra year till 2024 to take the withdrawal and not have it taxed to the higher taxed spouse. So that's an unusual way to use spousal RSPs, but it is something that some people will do, again, leading into retirement, but not necessarily right there. Prescribed rate loans are a way that you can shift income, investment income, from a high income spouse to a low income spouse. If you just give to the lower income spouse, then the investment income is taxed back to the higher income spouse. But if you set up one of these loans, and there's more details in the written piece that we mentioned, if you set up one of these loans, then the investment income is taxed to the lower income spouse. The year-end issue is actually year-end plus 30 days. That interest on these loans must be paid during the year that the money is outstanding on the loan, or within 30 days of the end of the year, which means January the 30th, not the month of January. It's actually January the 30th. If you don't keep in line with the rules, then thereafter, for all years thereafter, you are not able to get the income splitting that you're trying to get. It, in fact, will end up that the higher income spouse is taxed on the investment income. If you want to get around or not run into a problem with any year ends at all, then one of the things that can be an alternative or a complement to doing either of the previous types of strategies between spouses is simply to give money to a spouse. Spouse puts the money into a tax-free savings account, and there's no attribution. So those are a few different ways that you can try to split income in the household. And the last item here is about changing a past tax return, applying to any taxpayer. If you make if you have an issue with your tax return all the way back to 2010, so it's a 10-year time period, you can refile that tax return and recover whatever taxes might be associated with it, but it is a 10-year time period. So this year, but before the end of 2020, you must refile your 2010 tax return. Okay, so let's move on and look at employee issues. As you mentioned, Paul, there is the this unusual situation where we have a lot more people who are working from home, some by choice and others without the choice for having to do that because we've got this pandemic that we're managing with. And the question does come up, do you or can you deduct expenses related to your home? And in most cases, unfortunately, you likely will not be able to do that. Your employer has to fill out a form. It's called a T2200, and it has to be shown on that form by the employer's statement that it is a requirement of your employment that you in fact maintain a home office in that case. And it's not likely that it will be in most cases a requirement of your employment, so you're not likely going to get that. However, when the pandemic started, one of the concessions that the Canada Revenue Agency made is that where people are working from home and need to purchase equipment, computer equipment or higher level of service, and the employer then reimburses the employee for those payments, such as, again, internet service providing, then up to $500 of those reimbursements from the employer will be treated as non-taxable. And then the CRA further extended the treatment, not the amount, it still maxes out at 500, but the treatment to include office furniture, office equipment that you might purchase that will, again, assist you in working from home in the current times. Any other reimbursements that are of a personal nature might be nice for your employer to have done that, but those will be taxable amounts. And then the last item here, as someone who unfortunately may be in a lower income position because you have had reduced work, this is a general issue with year-end tax planning about perhaps triggering taxation on investments, rental property. Sometimes that would be a very large one where you might sell off a property in years when you expect or you are in a lower tax bracket than you might otherwise be in other years. So as I say, selling off a rental property would be a very large one, but this year might be a relatively low income year for you right now, and you'll go back up again next year. This might be a time to sell some of your investments, not to sell them and get out of the market altogether, but look at realizing capital gains on some of your investments while you're in a lower tax bracket right now, and then reinvesting those funds. And I'll talk a little bit more about the implications of buying and selling securities and investments when I talk about capital gains a little bit further on. So from there, let's move on to the next topic to look at education and students. And one of the things that we have with our education financing is the availability of the RESP, the Registered Education Savings Plan, and associated with it is the Canada Education Savings Grants, which are 20% matching grants. For the amount that we put into, the government will kick in that 20%. There are some maximums involved with it. I won't get into the full figures here, but the key issue that I want to highlight is that for people who are saving with an RESP, the grant money, again, a 20% matching grant that's available from the government, in the years that the student beneficiary is age 16 and 17, you will not be entitled to that grant money unless by the time that the student hits age 15, one of two rules have been fulfilled. It's either that at least $100 has been contributed in each of 4 years by the time the student gets to be 15 years old, or that there is at least $2,000 in the plan by that point, again, age 15. So if you're in that position where you haven't funded up the RESPs all that much, then make sure that by the end of this year, and I'll just deal with the one issue about the $2,000 figure if there isn't any money in there yet, put $2,000 into that plan, which will then open up the availability of getting the grant money in those later years. And for the benefit of a few numbers here, the $2,000 will get you 20% grant, so that'll give you $400 bucks. And then the amount that's available, the maximum amount that you'll be able to collect in each of those following years is as much as $1,000 per year when that student is 16 and 17 years old. So you open up the door for another $2,000 of money that could come from the government. In terms of the RESP withdrawals, the money that comes out of the plan that is used for education financing directly to the institution or supporting the student's education, that is taxable to the student. So if you have a student who is going to graduate next year, as an example, you may want to make sure that you have all the withdrawals or as much withdrawals happening in this year before we get to the end of this calendar year, so that it is taxed at a relatively lower tax bracket than is anticipated than next year, which is when that student will start working, go out into the working world. As difficult as the pandemic is, then hopefully that will be somebody who has a good position available to them. The third item here with the lifelong learning plan, it is an offshoot or a part of the RRSP program. So RRSPs, Registered Retirement Savings Plans, primarily for retirement, but if you need to get some retraining, some re-education, you can take money out of the RRSP, your RRSP, but you have to put it back in again. And the amount that you can take out is a maximum of $10,000 per year to a total maximum of $20,000. So depending on your circumstances, if you are looking at getting some retraining next year, let's say, and the amount that it's going to cost is in excess of $10,000, then you'll want to take out a sufficient amount this year before December 31st, so that in combination with what you take out after the new year, you'll have enough to pay for that financing of the education. And then again, in a couple of years' time, once you complete that education, you'll have to start putting the money back into the RRSP. Last item here on student loans is that when you have a loan to a student, which is a government-sponsored loan, you get it from a financial institution, but it is backed up by the Canada Student Loans programs, one of the programs. The interest payments on the repayment of the loan money, the interest payment is deductible for that student. It's not transferable to anyone else, though. And so when the interest is paid, that student gets the deduction, but the student may not be able to make use of the deduction, perhaps not working just yet when the repayments are being made. And so it can be carried forward up to 5 years. So this year, 2020, is the last year that the student will be able to claim interest payments that were made back in 2015. So if you have somebody, child or a grandchild, who is paying back those types of loans, then make sure that you take a look at when they've made their last payments and whether they claimed them. And again, 2015 will be the year that will fall off the books if you don't claim those amounts. Paul, I'm going to do a sound check here. Let me know, am I still making sound here?
You sound good to me, Doug.
Okay.
Look good too, buddy.
All right. Thanks. Okay, next one that we're going to deal with here is looking at homeowners and house hunters. With some of these topics, I've kind of squeezed in topics that don't fit directly necessarily under the categories, but otherwise there's no easy place to put them. And this is perhaps one of them where you're making large TFSA withdrawals. I just want to use this as an opportunity to remind people of the point that when you take money out of a tax-free savings account, you get the ability to contribute back in the money on a dollar for dollar basis. But you can't do that until the following January the 1st. So you can't keep on going in and out over the course of the year, or you'll exceed your contribution room and get into penalty area. So let's say that you were going to buy a house next year and you'd accumulated money in a tax-free savings account. You're going to pull it out to make that purchase in February, let's say. If you were to pull the money out in January, then your credit for recontribution would be January the 1st of the next year of 2022. But if you take that out now or in December, then you'd be able to put the money back into the plan, or a TFSA, anytime during the course of next year. So chances are, if you just bought a house, you don't have a lot of extra cash anyway, but should you be doing some kind of a large purchase and you're going to withdraw from your TFSA, better to take it out late in this year than early next year in order to have the room available to you to go back in again. Second item, similarly to the lifelong learning plan, it's the RRSP home buyers plan, and I want to underline the point again. RRSPs are for retirement. This is an extra use that can be available to you if you want to make use of your RRSP to assist you in making a purchase. And what happens with the home buyers plan is that you can take out individually up to $35,000 out of the plan. And so if there's a couple that's making a purchase, you could have about $70,000 if you both had that much in your RRSPs respectively. You could use that towards down payment of a new home. You have to be a first-time home buyer in order to do that, and there are some timing issues. Once you take the money out, you have to make the purchase in the year following the year of the withdrawal, within 2 years of the year of withdrawal. Take a look at the written piece to see what the full explanation of that means. And then once you've made the purchase, then you have to start making the payments back into your RRSP over the course of up to 15 years, starting the year after you make the purchase. So the RSP Home Buyers Plan, again, there's a number of year-end issues or yearly issues to keep an eye on there. The next item about principal residence is not specifically a year-end issue, but it is something that not all of us would run into on a regular basis. There was a change back in 2016, so a few years ago, to the reporting of the disposition of a principal residence. So the general rule is that your capital gains on your growth on a principal residence, they're not taxable. And up until 2016, you really didn't have to do much in order to claim that. You just simply sold the property and then didn't have to say anything about it. But now you do have to include that on the capital gains schedule to your income tax return. So if you sold a house during this year, be aware of that. Get the records together. You do have to provide the original purchase date and the address and the purchase cost to you, and you then claim the principal residence exemption. Just be aware of that, because if you don't do it on time, then you could be facing penalties. In the worst case, potentially it could be denied. But I have yet to hear about anybody having that denied. But be aware of that very large concession in terms of principal residence exemption, that you do have to report that if you concession from the tax authority, that you'll have to do that on your tax return coming year. And the last item about moving within Canada is that you are taxable, we are taxable on our income on or in the province that we are resident in on December 31st. So if you've moved from one province to another, if you were, let's say, in Alberta over the course of most of the year, let's say 10 months of the year, and now you're living here in Ontario, Alberta is generally a lower tax jurisdiction relative to Ontario. Then you might want to be able to file for 10 months of the year in Alberta and then 2 months in Ontario. But the fact is you get taxed all in Ontario. There's not much you can do at this point, nearing the end of November, to move back and forth, whatever you might think you might be doing. It's a fairly major event for people to move right now for this year, but it's something to be aware of in terms of your expectation of how you're going to pay your taxes. Because if you were living in Alberta over the course of the significant part of this year, the withholding tax from your employer would have been less than what it would have been had you been here in Ontario. So you might have to top that up some. And then as you go into future years, the opportunity you have is to say to yourself, do I want to move before or after December 31st? And be able to manage a little bit what the taxation is going to be in that year when you move in future. All right. So let's move off of the homeowners and talk a bit about people with disabilities. There are a lot of tax programs, tax supported programs that we have for people with disabilities. The Registered Disability Savings Plan is a big one, which has been around for almost a decade and a half now. It allows people who are eligible for the disability tax credit to put up to $200,000 in one of these plans, which then is tax sheltered. And then when it's withdrawn, then the income, which is made off of that those deposits, that income is taxable to the disabled person who is the beneficiary of the plan. The other part of it, the significant part of it, is that there is free bond money and matching grant money that is available through these plans. And the matching money, apart from the bond money, which again is free, there's nothing they have to put in order to get it, although there's income thresholds that you get less as your income goes up. The matching grants, though, are very significant, up to 300%. And so, just, not that you can't tell what 300% is, but if you put $500 in, the government puts $1,500 in. It does depend on the person's income level, just how much you get of those matching grants. And the ages that are relevant here and the year end, the way that we talked about this topic is it's about time of year, but it's also about time of life. In this case, it's about the age of the people who are involved. You cannot put any money into an RDSP. You can't open one after the age 59 of the person who's the beneficiary, and you only get the grant and bond money up until the person is 49 years old. So if you have somebody who is eligible for the disability tax credit and does not yet have an RDSP open, then take a read through the material and look at setting that up. The second item is for people who are seniors. You have to be over the age of 65, again, eligible for the disability tax credit. You can spend up to $10,000 per year. It doesn't have to be just this year. It could be any year, and you could do it again next year if you are improving the property that you have, your living space, to make it more accessible and safer for you. Again, you have to be over 65 and eligible for the disability tax credit. This the federal credit here is worth 15%. So a $10,000 spend to do some kind of a refurbishment will give you a $1,500 tax credit. And I should note here as well, you may recall that the Ontario government announced a tax credit similarly, which there had been an Ontario credit in the past, but there was one that was announced in the economic statement just recently. It does not apply for this year. It applies beginning in 2021. So this here, the home accessibility tax credit, is specifically the federal one that applies right now. The last item here about medical expenses is that with medical expenses, they are not actually lined up with the calendar year. You can claim medical expenses for a year in time where the last day of that year ends in the current taxation year. So I know it sounds kind of wacky, but let me give you an example of that. Let's say that you had a child who had had to get braces, and that happened in September of 2019. And then you had another child, maybe they're twins and one of them was a little bit delayed, who also had to get the braces, and that was in July of 2020. Well, those are two different calendar years, and those are pretty expensive costs. And the way that the medical expense tax credit works is you don't get the credit until you break through a certain income threshold, a percentage of your income, around about $2,000 to $3,000 or so in most cases. So if you can combine those two, then you're going to break through that threshold sooner than if you had to do it on a calendar year basis. So you could choose the year so that the end of the 365 days, you would start perhaps in September of 2019 and end in August of 2020, so you'd be able to combine those two amounts. So as you are nearing the year end, one, be aware of that, and two, if you do have expenses that could happen now or could happen a little bit out into the future, you may want to either accelerate or delay those in order to get yourself up over those thresholds to be able to claim the medical expense tax credit. I'm going to check in. We're going to push to the next slide. I'm going to check in with you again, Paul. You let me know if I'm still vocal here.
All good, Doug. I will let you know. Thank you.
Okay. All right, so with seniors, there are a number of things that happen with seniors. The first one here is just a general reminder. It's not senior specific, really. It's just about Rrsp contributions. Quite often what we'll do is we'll make contributions, again, in the first 60 days of the year because it's the old style Rrsp season. But in doing that, you might want to, if you have the cash available now, get going with contributions earlier, which gets your tax sheltering going sooner than waiting until the new year. And if you set it up on a routine basis, an automatic contribution to the plan, then you don't have to be so concerned about either year end, the calendar year end, or about that first 60 days. You're into that routine and it's out of your budget. You don't have to be concerned about it, and it will take care of itself over the course of time. So just generally, it's good to have some systematic way to go about Rrsp contributions that can get your savings going and beefed up. So specifically about seniors now, in the types of things that you take in your retirement years, public pensions. So there's two main public pension programs: the Canada Pension Plan and Old Age Security. Both of them have what's generally referred to as the normal retirement date, normal commencement date of 65. But in fact, with the Canada Pension Plan, you can take it as early as age 60. You take a small penalty for every month that you take prior to 65, and you can take it after 65 all the way up to age 70. And for every month that you delay, you get a little bit of a premium on the amount that you get. So you have a whole range of 60 to 70 for the Canada Pension Plan. With the old age security, you can delay from the age 65. You can't take it earlier, but you can get a premium for every month that you delay all the way up to age 70. So if you're anywhere within that range of time, then you might want to look at when you start those, and particularly as you're looking towards next year, if this affects you. The government says that you're looking at somewhere around 6 months from the time that you give your notice to them, that it may take until the payments actually begin. So before you get to the end of the year, not that everybody focuses on taxes throughout the year, but this is the time we tend to think about it, it might be a good idea to look this over and make a decision about what you want to do when you want to start those programs. The second item here is the Canada Pension Plan post-retirement benefit. And that's a relatively newer, it's been around for about 6 or 7 years now, a component of the Canada Pension Plan. And what it does is, if you are taking the Canada Pension Plan, so you're taking a retirement pension, but you are continuing to work, then premiums for the CPP are still taken off of your paycheck, which then increments or increases the CPP retirement pension in future years. And this is the increment is called the post-retirement benefit. When you are under the age of 65 and working and receiving the CPP, those continuing premium payments are mandatory. But if you are over 65, it's elective for you. So if you want to stop those, if you don't want to pay the premiums, if you want to just leave things as they are with your CPP retirement pension, you must give formal notice to have those stopped, and you can only do it once a year. So if you're nearing your age 65, then look at the form that's associated with this and decide whether you want to continue to pay those premiums and get the increment, or stop the premiums and then you continue on with the retirement pension you have. The next two items are similar to one another. Age 71, an RRSP is an accumulating tax sheltering plan. You can only keep it until December 31st of the year that you turn 71. You must convert it into either a registered annuity, so payments from year to year, or into a registered retirement income fund, or take it as a lump sum. So you have to do that by December 31st of the year that you turn 71. So if that's you, hopefully you've already spoken with your financial advisor and made these arrangements, but if not, then make sure that you do that. And then in a similar way, once you pass that time point, after you get past December 31st of that year, you can't make any further RSP contributions. However, I said as a blanket statement, but where you have a spouse who is younger than you, you can use your RSP room to make a contribution into a spousal RSP. So a very important year when you're turning 71 to make sure you understand how this works and what your options are. So again, speak with your financial advisor. The next to last item on the page here is about the pension credit. The pension credit is, there's both the federal and the provincial credit associated with this, but I'm just going to use the federal one as the example because it's a nice round number. On the first $2,000 of money that you take out that is eligible pension income, you get to claim this 15% credit, which means that on that $2,000, you are able to reduce the tax by $300. So not a bad deal to be able to do that. The type of income that's eligible for this, if you are receiving registered pension plan money, then it applies at any age. But if you're drawing money out of a registered retirement income fund, a RIF, you have to be at least age 65. And so if you have RSP money, let's say that you don't have a registered pension plan, but you have RSP money and you want to defer that out in time, perhaps as late as age 71, if you do that and you don't take any money out of your RSP, then you're leaving behind the opportunity you have to claim this credit. So what you can do is make sure that you turn a sufficient amount of your RRSP money into RIF money or into an annuity payment so that at least $2,000 is paid on a yearly basis once you hit age 65 so you can claim this pension credit. The last item here about rollovers on death is that if unfortunately you had someone die and you are the beneficiary, generally we're talking about spouses. This can also apply where you have a dependent child of the deceased person, but most often between spouses. If you had a spouse who died last year in 2019, in order to get the rollover without taxation, the deferral over to the receiving spouse and continuing on as a registered plan and not be taxable, then the rollover must occur before December 31st of this year. You might think, well, why would it take so long to do these things? Don't know why. It might be that people just were in grief, didn't get around to it. Maybe there was some conflict going on. But again, December 31st of 2020, this year, if someone had died in 2019, in order to get that rollover, otherwise it runs the risk that that plan will become taxable. All right, so let's move on to our next topic here, talking about investors and markets. I mentioned earlier about capital gains that you might trigger. One of the things that you can do, and this has been an odd year for us that we've seen this year, that markets have gone up and down. Well, went down, down first, and then they've come back again. You might be in a position where some of your holdings in your non-registered investments are in a loss position. And so you might want to use those losses to apply against capital gains so you can reduce down the capital gains that you face this year, and you can also carry back to previous years. So once you've applied capital losses against capital gains in the current year, then you can carry back as much as 3 years into the past and then indefinitely into the future in order to reduce down the taxes that were associated with that other year, and you'd refile your tax return. So if you had capital gains in 2017, then this year, 2020, is the last year that you'd be able to have capital losses occur this year to carry back to offset the 2017 capital gains. The second item here is about when you do this, and I suggest you don't push it right to the very end. But when you make a trade on investments, whether that is individual stocks or it's mutual funds, there is the trade date, and then there's what's called the settlement date. The settlement date is 2 days after your trade date. If you want a capital gain or a capital loss to occur in 2020, then the settlement date must be in 2020. So the last day that you can make a trade in order to keep it in 2020 is Tuesday, December the 29th, which then that's the trade date. It will settle by December the 31st on Thursday, and that will be this year. The next last item is interest and mutual fund expenses, or interest and fee expenses. If you have fees that apply to your investments on your non-registered investments, or interest that you have that you've paid, you must pay those amounts before the end of this year in order to get the tax deduction associated with them during this year. So again, it has to be this year. You can't pay them in the new year referring back to this year. You must pay them this year. Last item here is about mutual funds at year end. If you have non-registered investments and you're looking to purchase a mutual fund before the end of the year, you want to be careful, because if you purchase that near the end of the year and then the mutual fund has its record date shortly after you make the purchase, what happens with the mutual funds is they distribute out the tax liability associated with their distributions over the year to those who are on record at the record date. And what that does to you is it causes you to be taxed on income that you didn't actually receive. Now, it is reconciled with the cost base of your investments when you ultimately dispose of the investments later on, but in the meanwhile, you're out of pocket for that. So if you're contemplating to purchase in a non-registered account mutual fund, then you might want to wait to speak to your financial advisor. You might want to wait until the new year to not face this issue. It does not apply with RRSPs, Rrsps, with registered accounts. It is only with non-registered accounts that you have to be careful about this. Next to last category of topics that I'm going to touch on here is about business owners. So let's move on to the business owners, and I'm just going to make a short statement about this, because if you're a business owner, I would expect that you have an accountant, you have advisors that are assisting you with that business, and you're having conversations with them. But I'll just make this general statement, with leaving these points that are up on the screen. I'm not going to get into them. I'll just make the general statement that a couple of years ago, you would know that the federal government made some changes to the way that corporations in particular were taxed, small business corporations. And what it did was it focused on the passive income. If you had excess money in a corporation that was earning portfolio investment income, then it might affect your ability as the business owner to claim the small business tax rate, which is it's inside the corporation, so that gives you a lower rate than what otherwise might be personally in most cases. But the small business rate is also about 12 to 13% or more less than the general corporate rate. So if you have passive income in your corporation, then that could affect your decisions about what you do with your business. So I said I was going to make it a short comment. I just wanted to raise that as the issue, and that you need to speak to your accountant about whether you make dividends before year end or pay bonuses before year end, and how you pay them to yourself as the founder of the business or to other people, including family members, and what the tax implications of that might be. So let me leave that alone. And again, there's more detail in the written piece that we have. And the last topic I want to touch on is about estate planning and about charitable giving. So in terms of charitable giving, if you want to make a donation to charity and you want it to apply for this year, for 2020, then you have to make that during this year. So we don't have the same rule as there is with RSPs, where you can contribute in the first 60 days of the year and then have that applied back to the preceding calendar year. You actually have to make the contribution during this year. Now, that's not a fatal concern for most people, because when you make a contribution to charity, you can carry the credit forward by as much as 5 years. So there's a lot of maneuverability with this, but if it's critically important to you that it happened this year, then make sure that you do that before year end. In terms of how you go about doing that, one of the things to do your charitable giving more strategically is to look at donating securities, non-registered investments, so stocks or mutual funds that have increased in value, donating those things in kind, in their form as a security, rather than donating cash. And if you do it that way, then it might be a more tax effective way for you to make the donation to the charity, if you look at it in one respect, or it might be a way that you can donate more to the charity. So I'll give you an example of this. If you had $100 cash and you also had a security, a mutual fund that you bought for $20 that is now worth $100, well, if you donated the $100 cash, those are your two options. You gave the $100 cash, you would be sitting there with something in your hand that has a waiting tax liability on an $80,000 capital gain, because you bought it for $20, it's now worth $100. So you're going to have less than $100 once the taxes are paid on that. But if you hold on to your $100 cash and you donate the security in kind, then effectively the capital gain, the $80 in growth, is effectively negated. So the charity gets $100 and you get a tax credit based on contributing or donating $100. So a good way to try to either give more, so you can give a larger amount, or have it cost you less to make the donation. And the last thing that I have here is to review wills and powers of attorney. Again, not an actual year-end issue, but if your mind is focused on these kinds of planning issues from a tax standpoint, and we're coming near year-end, we're probably not going to see in person as many people as we otherwise would see, but we do tend to interact with our families, with those people who are important to us as we're nearing year-end. And so it's a good time to think about, is my will up to date? Are my powers of attorney in place and up to date, to make sure that the whole plan, the tax and the estate planning, are working together. So Paul, that's as much as I'm going to go into here, and I want to shoot it back to you. Hopefully you've got some questions there, and I'm sure that had I not been making any sound, you would have alerted me. So
certainly would have tried. No, thank you, Doug, and appreciate. There's a lot. Obviously, the tax and CRA rules and everything else can be complex, and they can sometimes feel overwhelming. So I appreciate your approach to this. For any of our listeners who haven't asked a question but may have some, please feel free to contact your Libro coach, and I'm sure they'd be happy to start that conversation with you. If you don't have a Libro coach, now's a great time to start. So first question was with respect to RESPs. Can you confirm if I have funded an RESP in previous years and my child is turning 17 this year, are they still eligible for grant money payable in the 17th year?
They are, as long as you hit the, either of those two rules, the $2,000 by age 15 or $100 in each of 4 years prior to age as late as age 15. That one's probably the easier one to hit dollars wise. But you are entitled to then make contributions in the age 16 and 17 years and get the room that comes to you in the grant room that comes to you in those last 2 years then.
Perfect, thank you. And the other one of the other questions comes from Stuart. Thanks, Stuart. With regards to the employer reimbursement, the non-taxable portion for work from home equipment, what government paperwork is required by the employee or the employer to make this happen?
There's no specific paperwork that's just for that reimbursement. So the $500 amount that the CRA is conceding or allowing for either internet access or telecommuting equipment or furniture. You don't have any particular paperwork involved with it, but any specific paperwork, but you should have the receipts associated with it. Keep those receipts yourself and provide copies to your employer if your employer is asking for those, so you can back it up if you're ever asked about it.
Okay, great, Doug. I'm going to put you on the spot, if you don't mind, for a question. We haven't pre-planned this one, but I was curious, what are the most common tax filing mistakes Canadians make in your experience?
Common tax filing mistakes. Wow. Well, I did touch on that one right at the very beginning, very first point that I made about getting a refund. That's probably, I wouldn't call that a mistake. It's a result of the fact that you're an employee and there is withholding from you by your employer based on payroll tables. And sometimes people look at that as wear it with a badge of achievement, the fact that they got a refund, but in fact it's arguably poor tax planning to do that, because you let the government use your money for a much longer period of time than you had to do. And again, as I say that, for some people it provides them with focus to get that refund and then do a reset on an annual. I wouldn't say that it is necessarily bad, but that's probably the one place that you could fairly easily make an adjustment if you want to file that T1213 and then use the excess that it allows you from paycheck to paycheck to immediately go into investing rather than waiting for the lump sum that would happen in March or April of the following year.
Yeah, certainly one that would require a bit of personal analysis and depend greatly on the individual situation.
Yeah.
Speaking of taxes, question that I know my spouse has asked me before, should we do our taxes ourselves? How do I know if I should use the professional services of someone like an accountant versus using an online tax program?
Well, I think that if your income, if you are a straightforward employee, if there is only employment income that you are receiving, that would be the simplest of cases where the way that the system operates generally, it's a check and balance system where those who are paying amounts are reporting, particularly employers, they are reporting over to the Canada Revenue Agency, and then you as the receiver of that are required to file your return, and then your slips and the employer slips then merge together, and everything is all tied like a bow over at CRA. So a straight up employment situation, I don't think that you'd find that there is much complication associated with that. But as you get further away from that, if you have a business, pretty obviously, more complexity, deductions that you may be able to claim, you'd want to make sure that you're claiming the appropriate amounts, because it could be a nasty surprise if you were doing something which you seem to believe was just fine, but is outside the rules. Then you might owe more taxes, you might face interest, and you might face penalties. So businesses, that would be something to be more aware of. And then where you've got situations like a family member who has a disability, something where you have support payments, you want to make sure, at least on the first occasion when you're filing, the first year when you're filing, any kind of those more unusual, not straight down the line of the straight up employment income only, you might want to get assistance that first time around at the very least, and then maybe you can take it from there depending on what you learn from that.
Well, thank you, Doug. That was a great session today. Again, a lot of information. This replay of today's webinar will be available on our events page, as are all of our recent webinars. There will be, as we noted at the beginning of the call, a follow-up item to come, bulletin type format from Doug, going into some of these issues in significantly more detail. If you do want to speak with one of our coaches, please feel free to contact us anytime. I know that our coaches, our wealth advisors, financial planners, financial advisors, etc., do deal with a lot of questions from business and farm owners, from individual taxpayers, and the range of questions from everything from tax loss selling to RSP versus TFSA and what works for me really comes down to you and your individual circumstances. Above my shoulder, this one, I've got it backwards on my screen, you may be able to read the "What's Your Plan?" That really is what our Libro coaching offer boils down to, is that we believe that owners are best served with a financial plan. The complexity of that financial plan, obviously, depending on your personal circumstances. But we have coaches that can help regardless of where you might be in your current financial prosperity, and we'd love to help you grow it. You can visit us at libro.ca, you can book appointments, you can call our contact center, you can find a branch or ATM. We'd love to hear from you. Appreciate your time today. Hope you learned something, or at least got reminded of some previously good information, and we look forward to hosting future webinars in the near future. Thank you, everybody, and have a great day.